Hello, Ben Kingsley here, and today I want to talk about negative gearing versus positive gearing. Now, the difference between the two is an income outcome, which basically means that with negatively geared properties, we actually have to put some of our surplus cash in to support the investment, as opposed to positive gearing, where we actually get some return on that property straight up. Now, it's important to note there's a lot of technicalities in here, but I'm going to try and keep it fairly simple. Now, by fairly simple, I mean, over time, the majority of negatively geared properties actually turn positive. So the reason why we're actually investing in a negative geared property needs to be for another purpose, because ultimately we want passive income from both outcomes. Now, let me explain that in more detail. Let's look at what negative gearing is. It's basically the rent that we receive less the costs of holding that property. Now, what do those costs normally include? Well, it's normally the mortgage repayment, so the interest on that mortgage. It's also the holding costs, so if we're paying a property manager to manage the property, and if we've got body corporates, rates, all those types of things. The other clear message there is we need to understand that we might also provision for some maintenance. I mean, the idea is we've got to keep the property in a nice lettable order so we can keep our tenants happy to keep that rental income flowing through. Now, so once you add all those up, so you've got your income coming in and then you've got all your costs, you're left with a negative. Okay, so that's where our income from our other activities needs to support that. Now, in addition to that, or what can improve that picture, is what we call depreciation. Now, depreciation is in relation to what a house does. Effectively, over time, the house will depreciate in value. So we're able to write off some of those components of the house. Now, that is also a positive message from income point of view, because we can write those off, which means that we get a tax benefit associated with that depreciation, which means that the shortfall or the negative gearing position that we're in will actually potentially be less than what it is. So we have to put less of our money in there. Now, if we look at the positively geared side, it's exactly the same story in terms of we've got income coming in, and then we've obviously got those costs that I mentioned before. But at the end of the day, we've actually got a positive outcome. Now, the question's got to be to anyone who's investing is, so why would I invest in something that's losing money? Which is a great question. And I say to anyone out there who's serious about investing in property, it's crazy to invest purely for a negative outcome, okay, or for a tax outcome. That's just naive, but you'll see a lot of investment advisors talking about, look at all this depreciation that I'm getting, and to actually focus on that as an investment strategy. That's just dumb. All right, so we don't want to be dumb. I'll use an example. Let's say we go and buy a business, okay, and that business is worth $500,000, all right, and we're attracted by the fact that we're going to be able to save from a tax point of view. So we're going to run that business at a loss for 10 years on the proviso that the business is going to be worth $1 million in 10 years' time. Now, the reality is that not every property is suitable for investment. So you see a lot of people talking about, attractive off the plans or house and land packages with really large depreciation components, but they're just in the wrong location. So they run this business for 10 years and it doesn't grow in value. Now, they've been getting all these losses and accumulated losses, but they haven't seen their capital growth. So you should always invest for growth as opposed to negative gearing or tax benefits. Tax benefits are purely a fringe benefit associated with that. Now, and there are some great properties that have excellent growth. And the reason why they are negatively geared is because the growth in the value of the property and that area expansion in terms of the need and desire for people to get in there is what pushes the value higher. So rents are lagging. They actually have to catch up to try and get that type of outcome. So, when we're talking to our clients and advising them, we're actually talking about a growth strategy and looking at locations primarily, and then looking at the localised neighbourhood, and then looking at the property to see whether it stacks up. If it's negatively geared at that point and has got some depreciation, that's a bonus, as opposed to just going for a tax benefit. It's crazy to think that you'll get a $10,000 tax benefit, but you're going to lose $30,000 to $50,000 over 5 to 10 years. Just dumb. Okay, so that's negative gearing. From a positively gearing point of view, we're talking about, wow, if this property is going to deliver us that return on a month-to-month basis, Well, why wouldn't we just always go for positively geared? If it means it doesn't affect the family budget or the household budget, why wouldn't we just keep chasing more and more of these positively geared properties? Well, the argument for that is that you're going to have to accumulate quite a lot of them, because in reality, positively geared properties have limited growth opportunities. So the growth story is a timing story, whereas if you can pick the right time to get into the market, then you might see a bit of growth. But you've got to ask yourself the question, why is the property positively geared? In other words, why is the tenant willing to actually pay more to rent the property than to actually own it? Because, you know, in reality, their repayments, their rent would be the same as their repayments. So it comes down to the story, well, test the area. People don't want to live there, or it's a low socio-economic area where in reality people are conditioned to, you know, the generational of renting, and they just don't know any better. So we call that the non-aspirer. They're just going to go in there and keep renting that property. Well, they don't get good income. And they don't get good income growth. So the area struggles for that growth story. The other areas where you find positively geared properties are regional towns or mining centres, definitely, which have boom and bust cycles. So you've got to be prepared for low growth, but, you know, and the challenges of turnover in terms of tenants. So the capital growth story over here with negatively geared properties is one of more stable, more reliable, more structured, great properties in great locations, as opposed to the cash flow positive story over here, which is we've got to be ready for some bumps in the road and some timing issues around performance of growth, and it's just going to outperform on a growth story than what the negatively geared property is going to do. So let's wrap that up. Couple of key messages. You chase properties for growth, or you chase properties for income. The fact that they're negatively geared or cash flow positive and the tax story is a supplementary story, okay? Because if you just chase that tax story, you're going to be sold a lemon, okay? So that's number one. So, and that's my big message here is don't be buying these, you know, really well tantalised, well presented, well marketed properties on the mass. Sit down, do your sums, do your numbers, do your research. And it could mean that you might be better off buying an existing property over a new property. And then on the cash flow positive side, it's going to be a story of making sure, or be willing to understand that your tenants aren't necessarily going to be great, reliable tenants, and making sure your property managers do a great job in looking after it. So the story is make sure that you understand those things, and from an investment point of view, look at your own household, look at your cash flows. If you've got strong cash flows, then we would talk about a growth story. If you've got less in the bank in terms of surplus cash flow, then we might talk about a yield story or an income story. And it's a combination of those two as you build your portfolio that's going to give you a passive income for life. Thanks for watching.